The cheapest way to own Bitcoin through your brokerage account just launched this month, and it came from a major Wall Street bank that used to ban its advisors from even mentioning crypto. This is MSBT, the Morgan Stanley Bitcoin Trust. It started trading on April 8, 2026 on the New York Stock Exchange ARCA. It is the first spot Bitcoin ETF ever issued by a major U.S. bank under its own name. And Morgan Stanley manages around $6.2 trillion in assets, so when they enter a category, the whole industry pays attention. The launch was massive. MSBT pulled in $34 million on day one, then crossed $100 million in assets in its first week. Bloomberg ranked it inside the top 1% of all ETF launches in history. Mechanically, MSBT is a standard spot Bitcoin ETF. The fund holds actual Bitcoin. Custody is split between Coinbase Custody and Bank of New York Mellon. It tracks the CoinDesk Bitcoin benchmark 4 p.m. New York settlement rate. When you buy a share, you own a slice of a giant Bitcoin wallet the trust holds on your behalf. Here is what makes MSBT different. Its expense ratio is 0.14%. That is the lowest in the entire spot Bitcoin ETF category. BlackRock's IBIT, the $70 billion giant of the space, charges 0.25%. Fidelity's FBTC charges the same. Morgan Stanley undercut both of them by 11 basis points and started a real price war on Wall Street's hottest product category. But here is what they don't tell you. When two ETFs hold the exact same thing, in this case just Bitcoin, the fee is not your only cost. Liquidity matters too. IBIT trades hundreds of millions of dollars in volume every day with razor-tight spreads. MSBT is brand new and trades a fraction of that. A wider bid-ask spread can quietly cost you more on the way in and out than you ever saved on fees. This is the dirty secret of commodity ETFs. When the underlying asset is identical, issuers can only compete on three things: fees, liquidity, and brand trust. Morgan Stanley used fees as their wedge because they cannot outscale BlackRock overnight. They are betting that their 16,000 financial advisors will funnel enough flows into MSBT to close the liquidity gap over time. Performance, mechanically, will mirror Bitcoin almost one for one, minus that small fee. MSBT, IBIT, and FBTC all rise and fall together. The differences show up in your total cost of ownership over years, not days. So who is MSBT actually for? Long-term Bitcoin holders who want the lowest possible fee. Morgan Stanley wealth clients whose advisors can finally recommend Bitcoin in-house. And cost-sensitive institutional allocators where 11 basis points on a $100 million position is over $100,000 a year. Short-term traders are still better off in IBIT. A quick reminder. This video is education, not investment advice. Bitcoin is volatile, and a spot Bitcoin ETF does not change the underlying asset's risk. If this helped you understand MSBT, hit like and subscribe for more ETF breakdowns. And tell me in the comments, would you switch from IBIT to MSBT for the lower fee, or does liquidity matter more to you?